Before we begin, a quick and important reminder. I am not a licensed financial advisor, and this presentation is created for educational and entertainment purposes only. The information shared in this video does not constitute financial, legal, or tax advice. All investing involves risk, including the potential loss of principal. You should always conduct your own thorough research and consult with a qualified professional before making any investment decisions. Your financial situation is unique, and any action you take based on what you see or hear here is strictly at your own risk. Let me tell you a quick story about someone we'll call David. David did everything he was told to do. He went to college, got a good job, and was a fantastic saver. Every single paycheck, like clockwork, he'd put a few $100s into his savings account. He watched the balance grow, feeling proud and secure. He thought he was building a future. But one day, after 10 years of diligent saving, he looked at the price of a house in his neighborhood, the kind of house he'd always dreamed of, and a cold dread washed over him. 10 years ago, he was about $100,000 short of a down payment. Today, even after saving over $60,000, he was now $200,000 short. The finish line hadn't just moved, it was sprinting away from him. David was running on a financial treadmill, sweating and working hard, but ending up further behind. This story isn't just about David. It's the silent, frustrating reality for millions of Americans who believe the myth that simply saving money is the path to wealth. It's not. There is a silent, invisible tax that is eating your money alive every single second of every single day. It's called inflation. And your savings account, with its pathetic 0.something% interest, is a guaranteed to lose money proposition. That feeling of being stuck, of working harder but not getting ahead, it's real. And it's because you're playing a game where the rules have been designed for you to lose. But what if I told you there's another way? A way to get off the treadmill and onto an escalator. A way to have your money start working for you instead of you always working for it. That is the power of investing. And over the course of this presentation, I'm going to give you the playbook. We are going to expose the 10 most common, most destructive mistakes that keep 99% of new American investors poor, and we're going to give you a step-by-step, no-nonsense battle plan to avoid them. By the end of this, you won't just understand investing. You'll have the confidence to take control of your financial destiny. So let's start with the single biggest mistake of all. It's not picking the wrong stock. It's not falling for a scam. It's the mistake that guarantees a 100% loss. And that mistake is not starting. It's the paralysis of waiting for the perfect time. You tell yourself, I'll start investing when I get that raise. Or, I'll start when the market calms down. Or, I'll start when I have $10,000 saved up. Or my personal favorite, I'll start once I've read 10 more books and understand everything perfectly. This is not caution. It's fear disguised as logic. And this delay, this hesitation, is infinitely more expensive than any market crash you could ever experience. Why? Because you are willingly giving up the single most powerful force in the universe of finance. The magic of compound interest. Albert Einstein supposedly called it the eighth wonder of the world. He said, "He who understands it earns it. He who doesn't pays it." When you're just a saver, you're paying it through inflation. When you're an investor, you get to earn it. Let me make this crystal clear with an example. Let's imagine two friends, Emily and Jessica. Emily starts investing at age 25. She's not rich. She just puts in $300 a month into a simple, boring S&P 500 index fund, which has historically averaged around a 10% annual return. She does this for just 10 years and then stops. She never adds another dime. She just lets her money sit there and grow. So, her total contribution out of her own pocket is $36,000. Now her friend Jessica waits. She wants to be more responsible. She waits until she's 35 to start. But to make up for lost time, she invests the same $300 a month, but she does it for 30 years, all the way until they both turn 65. Jessica's total contribution is $108,000, 3 times more than what Emily put in. So, who has more money at age 65? It's not even close. Emily, who started early and invested less, ends up with over $1.2 million. Jessica, who started later and invested 3 times as much money for 3 times as long, ends up with around $680,000. Emily has almost double the money by investing a third of the cash. How is that possible? It's the time. It's the decades her money had to work for her, to compound, to have money babies that then grew up and had their own money babies. The cost of Jessica waiting 10 years wasn't just the missed contributions. It was the lost army of compounding dollars that she could never get back. The most important ingredient in the recipe for wealth is time. And it's the one thing you can't buy more of. So why do we wait? We wait because of 3 big myths. Myth number 1. I don't have enough money to start. This used to be true, but today it is complete and utter nonsense. We live in an age of financial technology where you can buy fractional shares. You don't need to buy a whole share of Amazon for thousands of dollars. You can buy $5 worth of Amazon. You can start an investment account with the same amount of money you'd spend on a cup of coffee. The goal isn't to get rich with your first $5. The goal is to break the seal, to overcome the inertia, to build the muscle memory and the habit of being an investor. Myth number 2. I need to time the market. I'm waiting for the next crash to buy low. This is a siren song that has lured countless beginners onto the rocks of financial ruin. Nobody can consistently time the market. Not the experts on TV, not your brilliant uncle, not even the most sophisticated hedge fund managers. Trying to do so is a fool's errand. The data is overwhelming. Time in the market is infinitely more powerful than timing the market. A study by Fidelity looked at the market from 1980 to 2020. If you had stayed invested the entire time, a $10,000 investment would have grown to over $760,000. But if you missed just the 10 best days in the market over those 40 years, just 10 days out of over 10,000, your return would be cut in half down to about $360,000. Miss the best 30 days and you're barely above your starting point. The best days in the market often come right after the worst days. By waiting on the sidelines for things to feel safe, you almost always miss the explosive rebound that generates the majority of the gains. And myth number 3. It's just too complicated. Look, I get it. The world of finance is filled with jargon, ETFs, Roth IRAs, PE ratios, designed to make you feel like you need a PhD to participate. But that's a lie. Getting started is as simple as this. 1. Open an account with a reputable, low-cost brokerage firm like Fidelity, Vanguard, or Charles Schwab. Takes about 10 minutes online. 2. Connect your bank account. 3. Set up an automatic transfer of a small amount of money each week or month. Could be $25. It could be $500. The amount doesn't matter as much as the consistency. 4. Use that money to buy a single broadly diversified, low-cost index fund like one that tracks the entire US stock market. That's it. That's the whole plan to get started. You have just created a system that puts your wealth building on autopilot. You're no longer relying on willpower. You're relying on a system. You've just beaten the first and most costly mistake in investing. You've gotten off the starting line. You've traded the financial treadmill for the financial escalator. So your first action item is not to read another book or watch another 100 videos. It's to take action no matter how small. Open the account. Set up the automatic transfer for $5 if you have to. The psychological win of starting is worth more than any potential gain or loss on that small amount. You are changing your identity from a saver to an investor. And that identity shift is the foundation upon which all future wealth is built. You've conquered the fear of starting. You've put your first money to work. But right at this moment, as you feel that first rush of excitement, you are standing on the doorstep of the second most common mistake. An emotional trap that derails countless new investors and turns their dreams of financial freedom into a nightmare of devastating losses. And it all comes down to how you react the very first time you see your account balance go down. It's a feeling in the pit of your stomach. A cold electric jolt that shoots up your spine. You've been so excited. You finally did it. You took a chunk of your hard-earned savings, maybe $5, $10, even $20,000, and you invested it. For the first few weeks, it was amazing. You'd log into your account and see green. Up $100. Up $500. You felt like a genius. You started daydreaming about that down payment, about paying off your student loans, about telling your boss you quit. The number on the screen wasn't just money. It was validation. It was the future. And then it happens. A news headline about inflation. A jobs report that spooks Wall Street. Doesn't even matter what it is. You log in, and for the first time the number is red. You're down $75. It's not a lot, but it feels different. The joy you felt gaining $500 is completely erased by the sting of losing $75. The next day you're down $300. The day after that it's $1,000. Suddenly, the app on your phone feels like a venomous snake. Every notification makes your heart pound. The news is screaming about a market plunge and a bloodbath. Your rational brain, the one that read all the books and watched all the videos about long-term investing, has been hijacked. A primal ancient part of your mind has taken over, The part that's designed for one thing, survival. And right now it's screaming, danger, get out, protect what's left. So you do it. You hit the sell button. You convert your shares back to cash, locking in a $1,000 loss. For a brief moment you feel a wave of relief. The bleeding has stopped. You're safe. But then a week later the market finds its footing. It bounces back. A month later it's hitting all-time highs. The investment you sold for $9,000 would now be worth $11,000. Not only did you lock in a permanent loss, but you also missed out on all the gains. You sold at the absolute bottom, and now you're sitting on the sidelines, paralyzed by fear and regret, watching everyone else's future get brighter. This is panic selling. It is not just a mistake. It is the single most destructive, wealth-annihilating behavior a new investor can engage in. It's the reason why the average investor dramatically underperforms the market itself. It's not that they pick bad investments, it's that they have bad behavior. They buy high out of greed and sell low out of fear. So why do our brains betray us like this? It comes down to a powerful psychological bias called loss aversion. Groundbreaking research by psychologists Daniel Kahneman and Amos Tversky proved that, for the human brain, the pain of losing is psychologically about twice as powerful as the pleasure of gaining. Losing $100 feels as bad as gaining $200 feels good. This is a survival mechanism. Our ancestors who were more worried about losing their food supply were more likely to survive than the ones who were happy-go-lucky about finding a new berry patch. But in the modern world of investing, this instinct is a catastrophic bug in our software. When your portfolio is going up, it's a nice, pleasant feeling. When it goes down, it feels like a genuine threat. Your brain interprets the red number on the screen not as a temporary fluctuation in the market value of excellent companies, but as a predator stalking you in the wild. And your only instinct is to run. So how do you fight back against millions of years of evolution? How do you stare into the abyss of a market correction and not flinch? You do it by building a fortress of logic and discipline before the storm ever hits. The first and most critical line of defense is this. You must know why you invested and what your time horizon is. Before you put a single dollar into the market, you need to write it down. I am investing this $10,000 in an S&P 500 index fund because I believe in the long-term growth of the American economy. My goal is retirement, which is 30 years away. I will not touch this money until then. This simple statement is your constitution. It's your anchor. When the market is crashing and your emotions are screaming at you to sell, you pull out this statement and read it. It reminds you that a 10% drop today is just a tiny blip on a 30-year chart. It reminds you that you're not a day trader. You're an owner of businesses. You didn't buy a flickering stock ticker, you bought a fractional share of Apple, of Microsoft, of Johnson & Johnson. Are those companies going to be worthless tomorrow? Of course not. Your conviction in what you own is the cure for your panic. If you bought a stock just because your buddy told you it was going to the moon, you have no conviction. You have no anchor. And when the storm comes, you will be swept away. The second defense is to radically reframe what a market downturn means. New investors see a sea of red and think danger. Seasoned, wealthy investors see a sea of red and think sale. Imagine your favorite store puts everything on sale for 20% off. Do you run out of the store screaming in terror? No. You rush in and buy more of what you love at a cheaper price. The stock market is the only store in the world where, when things go on sale, people run out the door. You have to flip that switch in your mind. A market crash is not the market ending. It's the market offering you the opportunity to buy future wealth at a discount. The legendary investor Warren Buffett said it best. Be fearful when others are greedy, and greedy only when others are fearful. Panic selling is being fearful when others are fearful. It's the exact opposite of what you should be doing. The third, and perhaps most practical, defense is to automate and ignore. The single best way to remove destructive emotion from your investing is to make it automatic. Set up a recurring investment from your bank account into your brokerage account every single week or every 2 weeks, on the same day you get paid. This is called dollar cost averaging. When the market is high, your fixed amount buys fewer shares. When the market is low, when it's on sale, that same fixed amount automatically buys more shares. You are mechanically, without any emotion, buying low. You are building wealth on autopilot. And once it's automated, the next step is crucial. Delete the app from your phone's home screen. Stop checking it every day. Constantly watching your portfolio is like constantly weighing yourself when you're on a diet. The small, meaningless daily fluctuations will drive you insane and make you quit. Your investments are like a bar of soap. The more you touch it, the smaller it gets. Set up the automation, trust the plan, and go live your life. Check in on it once a quarter or even once a year. Your future self will thank you. By having a plan, reframing downturns as opportunities, and automating your process, you build that logical fortress that will protect you from your own worst enemy, your primal fear. You will survive your first downturn, and you will come out the other side stronger, wiser, and wealthier. But mastering fear is only half the battle. Because what happens when the market isn't crashing? What happens when it's soaring? When your friend from college texts you about a crypto coin that's up 1,000% in a month, or you see a news story about a tech stock that has made ordinary people into millionaires overnight. That's when a different, but equally powerful emotion takes over. It's a gnawing, anxious feeling in your gut that you're being left behind. It's the fear of missing out. And this fear leads you straight into the second great mistake that cripples new investors. A mistake that can be even more explosive and devastating than panic selling. Chasing rockets. It's the siren song of the modern market, the promise of a one-way ticket to the moon. Fueled by memes, hype, and the collective roar of the internet. It's buying an asset not because you understand its value, but because its price is going vertical and you're terrified of being the only one left on Earth. And unlike panic selling, which is a crime of fear, this is a crime of pure, unadulterated greed, wrapped in the socially acceptable disguise of a once-in-a-lifetime opportunity. Let's rewind to January 2021. The world was still reeling, and a little-known corner of the internet called Wall Street Bets was about to become front-page news. The target? GameStop, a brick-and-mortar video game store that, by all rational metrics, was a slowly dying relic of the past. But a compelling story emerged. A David versus Goliath narrative. A band of retail investors, the little guys, were going to take on the giant Wall Street hedge funds who were shorting the stock, essentially betting on its failure. The plan was to buy up all the shares, force the price up, and trigger a short squeeze, bankrupting the giants and making themselves rich in the process. It was the perfect story. It had heroes, villains, and a clear moral crusade. And it started to work. The stock, which had been trading at under $20 just a few weeks prior, began to twitch. Then it jumped. Then it exploded. It went to $60. Then 100. 200. Suddenly it was everywhere. Your cousin who knows nothing about stocks was texting you about it. It was on every news channel, every social media feed. You saw screenshots of Robinhood accounts with astronomical gains. People turning a few $1,000s into tens, even hundreds of thousands, seemingly overnight. And that's when the FOMO kicked in hard. The rational part of your brain, the part that knew this was a struggling video game store, was silenced. It was drowned out by the much louder, more primal part of your brain screaming, "Everyone else is getting rich. You're missing it. This is your chance. Don't be a fool. Get in now before it goes to 1,000. So people piled in. They bought at $300. 400. They bought at the absolute peak, around $480 a share. They weren't investing in a business. They were buying a lottery ticket that they were convinced was a guaranteed winner. They weren't participants in a movement anymore. They were the fuel. They were providing what Wall Street calls exit liquidity. The money that allows the early, smart, and lucky investors to cash out at the top. And then just as quickly as it went up, it came crashing down. In a matter of days, the stock plummeted. From 480, it fell to 200, then to 100, then to 50. The screenshots of massive gains were replaced by stories of devastating losses. People who had poured their life savings in. College students who gambled their tuition money. People who took out loans, convinced they were on the verge of financial freedom, were now facing financial ruin. The dream of getting rich quick became the nightmare of going broke even quicker. The rocket ship didn't just run out of fuel. It disintegrated on the launch pad, and the latecomers were the ones who paid the price. This is the anatomy of a FOMO-driven mistake. It's a psychological trap with three powerful jaws. First, there's social proof. When we see a large number of people doing something, our brain assumes it's the correct thing to do. It's an evolutionary shortcut that kept us safe in tribes. But in investing, following the herd often means walking right off a cliff with them. Second, there's the narrative fallacy. Our brains are wired for stories, not spreadsheets. The us versus them GameStop story was far more compelling than any boring financial analysis of the company's debt or revenue. We fall in love with the story and forget to check the facts. And third, there's the simple, powerful engine of greed. The sight of easy money short-circuits our logic. It triggers the same dopamine receptors as a casino slot machine, pulling us into a cycle of what if, until we make a reckless bet. So how do you vaccinate yourself against this? How do you see a rocket ship taking off and have the discipline to simply wave from the ground? You need to build an unbreakable system based on a few simple, non-negotiable rules. Rule number 1. If it's on the nightly news, you are too late. By the time an investment story breaks out of the niche financial world and into the mainstream media, the party is almost always over. The massive gains have already been made. The people getting in now are the latecomers who are about to become the bag holders. The mainstream news is a trailing indicator, not a crystal ball. Treat it as such. Rule number 2 is a classic from the master himself, Warren Buffett. Never invest in anything you don't understand. Before you put a single dollar into a company, you should be able to explain in simple terms what that company does, how it makes money, and why you believe it will be more valuable in 5 years. For the people who bought GameStop at $400, could they honestly explain its path to long-term profitability? Or was the only reason for buying it because the price is going up? If your investment thesis is just, it's going to the moon, you're not investing, you're gambling. And the house always wins. Rule number 3 is the most practical. You need to create a FOMO fire break. This is a mandatory cooling off period you impose on yourself. The next time you see a stock exploding and you feel that irresistible urge to jump in, you activate the fire break. You force yourself to wait a full 72 hours before you're allowed to buy. The hype cycle for these things is incredibly fast. What feels like a sure thing on Monday can look like a total disaster by Thursday. This 72-hour window lets the initial emotional, dopamine-fueled excitement wear off. It gives you time to do actual research instead of just reading Reddit comments. During this time, your task is to find 3 fundamental reasons. Reasons that have nothing to do with the current stock price or the hype. Why this company is a good long-term investment. If you can't find 3 solid reasons, you don't buy. End of story. This single habit can be the difference between building wealth and incinerating it. By internalizing these rules, you're not just avoiding a mistake. You're fundamentally changing your identity as an investor. You're moving from being a speculator, a gambler chasing trends, to being an owner, a disciplined allocator of capital. You're trading the fleeting thrill of the casino for the profound, lasting satisfaction of building real, sustainable wealth. So you've now built defenses against your own emotions. You've learned to control the fear that leads to panic selling, and you've built a fire break to stop the greed that fuels FOMO chasing. You're ready to approach the market with a clear head and a steady hand. But what exactly should you be buying? You open your brokerage account, and you're faced with the dizzying universe of thousands of stocks, funds, and options. And this is where a third, much more subtle and intellectually seductive mistake lies in wait. It's the mistake that convinces you that you're smarter than everyone else, that you can pick the winners and avoid the losers. It's the siren song of the stock-picking genius. And this mistake is a killer because it feels so good. It whispers in your ear that you're not just an investor, you're a visionary. It tells you that you found the next Apple, the next Amazon before anyone else. This is the mistake of trying to pick individual stocks. Let me tell you about a guy we'll call David. David is sharp. He's a successful software architect, a logical data-driven guy who builds complex systems for a living. He's used to being the smartest person in the room. When he started investing, he looked at simple index funds and thought, that's for amateurs. That's average. I'm not average. So David started his hunt. He spent his nights and weekends not with his family, but on financial news sites, on Reddit forums like Wall Street Bets, on stock screening software. He was looking for the one, and then he found it. A small, innovative biotech company we'll call Gene Pioneer. They had a promising new drug in clinical trials. David read their press releases, he watched interviews with the CEO. He even tried to decipher their scientific papers. He convinced himself he had an informational edge. He felt a thrill like he was an insider. He took $20,000, a significant chunk of his savings, and put it all on Gene Pioneer. For the first few weeks, he was a hero. The stock shot up 15% on some positive preliminary trial news. He was euphoric. He did the math in his head, projecting his future wealth. He casually mentioned his brilliant pick to his friends at a barbecue. The validation felt incredible. This was so much better than just getting the average market return. Then, the company announced a secondary stock offering to raise more capital. The stock dipped 10%. No big deal, David thought. It's a long-term play. In fact, this is a buying opportunity. So he put in another $10,000, lowering his average cost per share. He was doubling down on his own genius. A few months later, the news hit. It came out before the market opened. a cold, sterile press release. The FDA had put a clinical hold on their flagship drug due to unforeseen side effects in a few patients. The stock market is a brutal, emotionless machine. When the opening bell rang, Gene Pioneer's stock didn't dip. It fell off a cliff. It gapped down 65% in a single second. David's $40,000 investment was now worth less than $14,000. In an instant, years of savings were vaporized. The panic was suffocating. He sold everything, locking in a catastrophic loss, not because of a plan but out of pure gut-wrenching fear. David didn't just lose money. He lost time, he lost sleep, and he lost the one thing he treasured most, his belief that he could outsmart the system. David's story isn't unique. It happens every single day to millions of smart, well-intentioned people who believe they can pick winners. They fail to understand a few fundamental, brutal truths about the stock market. First is the problem of information. As a retail investor, you are a guppy swimming in an ocean of sharks. You think you found some special insight by reading a news article or a Reddit post. Hedge funds and investment banks have armies of PhDs, ex-government regulators, and industry experts on their payroll. They pay for satellite imagery to count cars in Walmart parking lots. They analyze credit card transaction data in real time. They have supercomputers running algorithms that can execute trades in microseconds based on information you won't see for hours or even days. The edge you think you have is a complete illusion. You are bringing a butter knife to a drone strike. Second, stock picking turns investing into a personalized emotional roller coaster. When you buy an index fund, you're betting on the broad success of the entire economy. It's impersonal, but when you buy a single stock, you fall in love with a story. You get attached to the charismatic CEO, the world-changing product. Your ego gets tangled up in the stock's performance. And when your ego is on the line, you make terrible decisions. You'll suffer from confirmation bias, only looking for news that confirms your belief that you made a great pick. You'll refuse to sell a loser because selling means admitting you were wrong, so you hold on for the long term, which is just an excuse for praying it comes back. Third, and this is the mathematical nail in the coffin, even the professionals are terrible at it. Study after study, year after year, shows the same result. The vast majority of professional active fund managers, people whose entire full-time job with all their resources is to pick stocks, fail to beat a simple, boring, low-cost S&P 500 index fund over any meaningful period of time. Let me repeat that because it is the single most important secret in investing. The highly paid experts on Wall Street, for the most part, cannot beat average. So what is the statistical probability that you, David, spending a few hours a week after your real job, can consistently do what they can't? It is functionally zero. Thinking you can is the height of financial arrogance. It's like showing up to a pickup basketball game and thinking you can outplay LeBron James. It's a fantasy. The solution to this siren song is both profoundly simple and deeply humbling. Stop trying to find the needle in the haystack. Just buy the whole haystack. Instead of betting on Gene Pioneer or Tesla or Apple, you bet on all of them. You do this through a vehicle called a low-cost, broad market index fund or an ETF. The most famous of these is one that tracks the S&P 500. When you buy a share of an S&P 500 index fund, you instantly own a tiny slice of 500 of the largest, most profitable, most innovative companies in the United States. You own a piece of Microsoft and Google and Johnson & Johnson and Visa. If one of them, like our fictional Gene Pioneer, has a catastrophic failure, it's a tiny blip in your portfolio, cushioned by the success of the other 499 companies. You are maximally diversified. You have traded the impossible, stressful task of picking the winners for the simple, powerful strategy of owning the entire field. You are no longer betting on a single horse. You are betting on the entire race. Historically, betting on the long-term ingenuity and growth of the American economy has been the most successful bet in financial history. This is the core of passive investing. It's the ultimate work smarter, not harder approach. You give up the ego-driven fantasy of being a stock-picking genius, and in return you get better results with a tiny fraction of the stress and effort. You set up automatic investments into your index funds every single payday, and you get on with your life. You go to your kid's soccer game. You enjoy your weekends. You let the relentless compounding power of the entire market do the work for you. Now, buying the haystack is the right strategy. It's the cheat code that most people never find. But even for those who discover this secret, a new, equally dangerous temptation emerges. Once you own the market, the little voice in your head starts to whisper again. It says, okay, you bought the haystack, but you're smart enough to know when to buy it and when to sell it. This leads us directly to the fourth major mistake.
Disclaimer. The information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
The grand illusion that you can time the market. The desire to time the market is perhaps the most seductive siren song in all of finance. It whispers that you're not just a passive participant. You're a master strategist, a financial ninja who can dance between the raindrops of market crashes and bask in the sun of bull runs. It's the ultimate ego trip. You read the headlines, you see the trends, you feel the momentum shifting. You think, I can do this. I can sell at the top right before the fall, and then swoop back in at the bottom to scoop up everything on sale. Feels like a superpower. And let's be honest, who doesn't want a superpower that prints money? The entire financial media complex is built to reinforce this illusion. Every day you have so-called experts on TV. Their faces grim, pointing at scary-looking red charts, warning of an impending collapse. The next day, a different set of experts with wide optimistic smiles will tell you we're at the beginning of the greatest economic boom in human history. They create a narrative of a battle between bulls and bears, a dramatic story where you, the clever investor, can pick the winning side. It turns investing from a long-term, slightly boring process into a high-stakes, thrilling casino game. And your brain loves it. It's fueled by a powerful cognitive flaw called hindsight bias. When you look back at the 2008 financial crisis, or the dot-com bubble in 2000, or the flash crash of 2020, it all seems so obvious. The signs were everywhere. How could anyone not have seen it coming? This illusion makes you believe that you would have been smart enough to get out in time. You forget the thick fog of uncertainty that existed in the moment. You forget that for every person screaming sell, there was another, equally convincing person screaming buy. Hindsight gives you 20/20 vision, making you dangerously overconfident about your ability to see the future. But here is the cold, hard, unvarnished truth, backed by decades of data. Almost no one can successfully and consistently time the market. Not the hedge fund gurus with their supercomputers, not the talking heads on cable news, and with all due respect, not you. Trying to do so isn't just difficult. It's a guaranteed way to sabotage your own returns. Let me give you one of the most powerful statistics in all of finance. A study by JP Morgan looked at a 20-year period in the S&P 500. If you had stayed fully invested for that entire time, you would have earned a solid return. But if you tried to time the market and you missed just the 10 best trading days of that 20-year period, your total return was cut in half. Sliced right down the middle. Think about that. 20 years is over 5,000 trading days. Missing just 10 of them, the 10 best ones, crippled your portfolio. What if you missed the 20 best days? Your return was basically wiped out. And here's the kicker, the part that should send a shiver down your spine. The market's best days often happen right next to its worst days. They cluster together during periods of extreme fear and volatility. The very moment your gut is screaming at you to sell and run for the hills is often immediately before the market has a massive face-ripping rally. The people who sell in a panic almost always miss the rebound. By trying to avoid the valleys, you inadvertently miss the rocket ship that launches out of them. To truly hammer this home, let me tell you a famous story about Bob. Bob is, by all accounts, the world's worst market timer. He has the absolute worst luck imaginable. Let's say Bob started working in 1970 and diligently saved up $2,000 every year to invest. But Bob was terrified of investing. He waited and waited, holding his money in cash, until he felt absolutely certain the market was safe. His first investment? He finally got the courage to invest $6,000 in late 1972, right at the market peak before a brutal bear market that cut stocks almost in half. Terrible start. Bob was so scarred he didn't invest again for years. He just kept saving. His next investment wasn't until August 1987, when he put in another $45,000. This was literally at the peak, just 2 months before Black Monday, the single worst day in US stock market history. His timing was impeccably horrible. He gets burned again. He waits. He saves. Finally, in December 1999, at the absolute climax of the dot-com mania, Bob plows in another $68,000. We all know what happened next. The bubble burst and the market crashed for 2 years straight. You'd think he'd learn. But nope. His last major investment was in October 2007, when he invested another $64,000 right at the peak before the Great Financial Crisis, the worst economic downturn since the Great Depression. Bob's timing wasn't just bad. It was catastrophically, comically, unbelievably bad. He only ever invested at the absolute worst possible moments in modern history. So how did Bob do? After all that, by the time he retired, his portfolio was worth over $1.1 million. How is that possible? Because of one simple, powerful rule. He never sold. Despite his terrible timing, he bought and he held. Bob's story proves that the single most important factor in your success is not timing the market, but time in the market. The length of time you are invested matters infinitely more than the precision of your entry point. So what's the solution? If timing the market is a fool's errand, what does a smart investor do? The answer is beautifully simple and wonderfully effective. Dollar cost averaging. Dollar cost averaging, or DCA, is the antidote to the poison of market timing. It's an automated strategy where you invest a fixed amount of money at regular intervals, say $200 every single month, no matter what the market is doing. Whether the headlines are screaming bull market rages or financial Armageddon is here, your investment happens like clockwork. You put the process on autopilot and take your own worst enemy, your emotional, panicky brain, out of the equation. Here's why it's so powerful. When the market is up, your fixed $200 buys fewer shares. When the market is down, that same $200 buys more shares. Over time, this automatically causes you to buy more shares at lower prices and fewer shares at higher prices. It smooths out your journey and lowers your average cost per share. Think of it this way. When your favorite store announces a 50% off sale, you don't panic and run away. You rush to the store to buy more of what you love at a cheaper price. Dollar cost averaging forces you to have that same rational mindset with your investments. When the stock market goes on sale, which is what a crash or a correction really is, your automated plan keeps buying, scooping up incredible bargains while everyone else is running for the exits. This strategy transforms volatility from your enemy into your friend. It turns market downturns from a source of terror into an opportunity. It removes the impossible burden of trying to predict the future and replaces it with the calm discipline of a consistent, repeatable process. You're no longer the frantic surfer trying to guess which wave is the big one. You're the lighthouse standing firm, weathering every storm, knowing that your foundation is solid and your light will keep shining. By embracing dollar cost averaging, you are conceding that you don't know what the market will do tomorrow, next week, or next year. And that admission isn't a sign of weakness. It's the ultimate sign of wisdom. You've conquered the ego-driven need to be a market psychic. You've accepted that the real key to wealth isn't predicting the rain, but simply continuing to plant seeds, month after month, rain or shine. So you've automated your investing. You're buying the whole haystack a little bit at a time. You've taken your hands off the steering wheel. But then the car starts to shake violently. The news is screaming recession. Your portfolio is bleeding red. And every instinct in your body, every primal fear, is telling you to hit the eject button. This brings us to mistake number 5. Letting fear and greed pilot your portfolio. These two emotions, fear and greed, are the twin horsemen of the investing apocalypse. They are the puppet masters that have caused more fortunes to be lost than all the bad business decisions and market crashes combined. They are ancient, powerful forces hardwired into our DNA. Your brain isn't designed to watch a stock ticker. It's designed to keep you alive on the savannah. When it sees a threat, like your life savings seemingly evaporating overnight, it doesn't differentiate between a saber-toothed tiger and a stock market correction. Screams one thing, run. This reaction is what financial experts call panic selling. It's the act of selling your investments during a steep market downturn out of fear of further losses. Feels like the right thing to do. Feels like you're taking control, stopping the bleeding. But in reality, it's often the single most destructive decision an investor can make. Let me tell you about a guy named Mark. Mark was a diligent saver. For years he'd been putting money aside, and in 2019, he finally felt ready to invest. He put $100,000, a significant chunk of his nest egg, into a simple S&P 500 index fund. For a few months things were great. He was making money. He felt smart. Then February 2020 arrived. The world shut down. The market went into a free fall, the fastest 30% drop in history. Mark would check his account and every single day he was down thousands more. $10,000, $20,000, $30,000 gone. Poof. The news was a relentless barrage of apocalyptic headlines. Experts were predicting a new Great Depression. His friends were all talking about pulling their money out. The fear became a physical weight in his chest. He couldn't sleep. He finally cracked. Convinced he had to save what was left, he sold everything. He took a $35,000 loss, but he told himself, "At least I didn't lose it all." He felt a strange sense of relief. But that relief was short-lived. What happened next? The market hit bottom in late March, and then began one of the most ferocious, unbelievable rallies in history. By August, just 5 months later, the S&P 500 had already recovered all of its losses and was hitting new all-time highs. Mark watched from the sidelines, paralyzed. He'd sold at the absolute bottom. His $35,000 paper loss was now a permanent, real-world loss. And because he was too scared to get back in, he missed the entire historic recovery. He not only locked in his losses, he forfeited all the gains. Mark's story isn't unique. Millions of people did the exact same thing. They let fear make their decisions, and it cost them dearly. The ironclad rule of investing is that you don't lose a single penny until you sell. A market downturn is a temporary markdown, not a permanent loss. It's a sale. Imagine your favorite store puts everything on a 30% off sale. You don't run out of the store screaming, vowing never to shop there again. No, you rush in to buy more while things are cheap. The stock market is the only store in the world where, when things go on sale, people run out the door. The antidote to fear is perspective. Historically, the US stock market has a 100% recovery rate. Every single crash, every recession, every pandemic, every war has been followed by an eventual recovery and new all-time highs. Your job during a storm isn't to jump overboard. It's to lash yourself to the mast and ride it out. But fear is only half of this toxic duo. Its partner, greed, is just as dangerous, though it feels a lot better at the time. Greed manifests as FOMO, the fear of missing out. This happens during bull markets when everything is soaring. You see your neighbor who knows nothing about stocks suddenly bragging about the killing he's making on some obscure tech company. You scroll through social media and see posts about meme stocks going to the moon. Everyone seems to be getting rich overnight, and the feeling that you're being left behind becomes unbearable. This is where Sarah comes in. In early 2021, Sarah saw the mania around stocks like GameStop and AMC. Her feed was full of rocket emojis and diamond hands. The stories were intoxicating. People turning a few $1,000s into hundreds of thousands. The greed was a siren's call. She had a sensible, diversified portfolio of index funds, but it felt so slow, so boring. So she took a huge chunk of her savings, $20,000, and threw it all into the hottest meme stock of the week, right at its absolute peak. She didn't research the company's financials. She didn't understand its business model. Her entire investment thesis was, it's going up. For a day she felt like a genius. Her account was up. But then the music stopped. The hype faded. The institutional investors cashed out, and the stock began to plummet just as fast as it had risen. Within weeks, Sarah's $20,000 gamble was worth less than $5,000. She had bought at the peak of the hype and was now left holding a very expensive bag. She learned that greed makes you abandon your strategy. It makes you chase performance, buy high, and take on ridiculous amounts of risk without even realizing it. It turns investing into gambling. So, how do you defeat these two primal forces? You can't just will yourself to be less fearful or less greedy. That's like telling yourself not to be hungry. The only way to win is to take your emotions out of the driver's seat entirely. You do this by creating a system, a simple, boring, automatic system that runs on logic, not adrenaline. The first and most powerful tool in your system is dollar cost averaging, or DCA. We've touched on this, but its true power is as an emotion killer. With DCA, you invest a fixed amount of money on a fixed schedule, say $500 on the first of every month, no matter what. If the market is soaring at all-time highs, your $500 buys a certain number of shares. You might feel a little greedy and wish you could invest more, but the system says no. Just $500. If the market crashes 30%, and fear is telling you to run for the hills, the system doesn't care. Your automatic investment of $500 goes through as scheduled. But here's the magic. Because prices are now 30% lower, your $500 buys 30% more shares. Your system automatically forces you to buy low, at the exact moment your emotions would be screaming at you to sell. It removes the impossible task of timing the market and replaces it with the simple, consistent act of buying. It's the single best strategy for building long-term wealth and sleeping soundly at night. The second part of your system is creating a written investment policy statement, or an IPS. This sounds complicated, but it's not. It's just a one-page document you write for yourself, when you are calm and rational, that outlines your investing rules. It's your personal investing constitution. It should answer a few simple questions. What are my financial goals? What is my timeline? What is my target asset allocation, for example 80% stocks and 20% bonds? And most critically, what are the specific conditions under which I will sell? You can write a rule like, I will not sell any of my core index fund holdings during a market decline of any size, unless I need the funds for a predefined financial emergency like a job loss. This document becomes your anchor in an emotional storm. When the market is crashing and the fear is creeping in, you don't have to think. You don't have to debate. You just pull out your IPS and read the rules you made with a clear head. It's your past, rational self protecting your future, emotional self from making a catastrophic mistake. It's the ultimate circuit breaker. By building a system based on automation and predetermined rules, you take fear and greed out of the equation. You turn investing from a white-knuckle roller coaster ride into a boring, predictable process. And in the world of investing, boring is beautiful. Boring is what builds wealth. But even the best system in the world can fail if it's built on a shaky foundation. Putting all your money into a single stock, even with the dollar-cost averaging plan, is like building a skyscraper on a foundation of sand. This brings us to mistake number 6, failing to diversify. Think of it this way. You wouldn't bet your entire life savings on a single roll of the dice in Vegas, would you? Of course not. The odds are stacked against you, and the risk of ruin is absolute. Yet, thousands of new investors do the financial equivalent of this every single day. They hear a story, they see a stock chart going straight up, and they get a hit of that intoxicating drug called FOMO, the fear of missing out. They convince themselves, this is it. This is the one. They take their hard-earned money and push it all onto a single square. Let's talk about a guy named Kevin. Kevin's a smart guy, a graphic designer who saved up $30,000 for a down payment on a house. But the housing market was crazy, and he felt like his savings were just sitting there, losing value to inflation. One day at a barbecue, his brother-in-law, who always seems to know what's next, starts talking about this revolutionary electric vehicle company. Not Tesla, but a smaller up-and-coming competitor we'll call Electron Motors. He's showing everyone charts on his phone. The stock has gone up 400% in the last 6 months. It's the future, he says. They just got a new battery patent. It's a guaranteed 10-bagger. Kevin goes home and his mind is racing. A 10-bagger? His $30,000 could become $300,000. That's not just a down payment. That's the whole house in cash. The fear of missing out starts to claw at him. So he does his research. He reads a few glowing articles, watches a couple of YouTube videos from self-proclaimed gurus hyping the stock, and sees the online forums buzzing with rocket ship emojis. Everything confirms his bias. This is the one. So he does it. He transfers his entire $30,000 house fund into his brokerage account and buys shares of Electron Motors. For the first 2 weeks, he is a certified genius. The stock climbs another 15%. His $30,000 is now $34,500. He's checking his phone every 10 minutes, high-fiving himself. He's already mentally shopping for furniture for his new mortgage-free home. But then a short seller report is released. It alleges that Electron Motors' revolutionary battery patent is not so revolutionary, and that their production numbers are wildly inflated. The stock drops 20% in one day. The forums are filled with panic, but also cries of "hold the line," and "they're just trying to scare us." Kevin, caught between terror and hope, does nothing. A week later, a major legacy automaker announces they are fast-tracking their own EV production, using a more stable, existing technology. Wall Street analysts downgrade Electron Motors from buy to sell. The stock tanks. It plummets another 40%. Kevin's $34,000 peak is now barely $15,000. He feels sick to his stomach. Every time he opens his brokerage app, it's like a punch to the gut. The dream of a house is gone, replaced by a nightmare of regret. He eventually sells out of pure emotional exhaustion, locking in a massive loss, taking home less than half of what he started with. Kevin didn't lose money because he was stupid. He lost money because he made one of the most fundamental errors in investing. He failed to diversify. He built his entire financial future on a single fragile pillar. When that pillar cracked, everything came crashing down. This is called concentration risk, and it is the financial equivalent of playing with fire. Even the greatest companies on earth are not immune to disaster. Remember Blockbuster? They were on top of the world, and then a little company called Netflix showed up. Remember Nokia? They practically owned the cell phone market, until a computer company from California decided to make a phone without a keyboard. The solution is a concept so simple, yet so powerful, that it has been called the only free lunch in investing. Diversification. It's the simple idea of not putting all your eggs in one basket. But let's use a better analogy. Think of your portfolio as a professional basketball team. Would you build a team with only one player, even if that player was Michael Jordan? No. What happens if he gets sick? Or has an off night? Or gets injured? Your team is finished. A championship team has a star player, yes, but it also has a dominant defender, a lights-out three-point shooter, a brilliant playmaker, and a deep bench. Each player has a different role. When one player is struggling, the others can step up and carry the team. Your portfolio needs to be built the same way. You don't want just one stock. You want a team of hundreds or even thousands of great companies. You want companies from different industries: technology, healthcare, banking, energy, consumer goods. When the tech sector is having a bad year, maybe the healthcare sector is thriving. You want companies of different sizes, giant stable companies like Apple or Johnson & Johnson, but also smaller, faster-growing companies. And you want companies from different countries: the US, Europe, Asia. You want a global all-star team. Now you might be thinking, that sounds incredibly complicated and expensive. How am I supposed to buy thousands of different stocks? 20 years ago it would have been, but today it is ridiculously easy and cheap. The answer is in two little acronyms: ETFs and index funds. Exchange-traded funds and index funds are like baskets that hold dozens, hundreds, or even thousands of different stocks all at once. When you buy one share of an S&P 500 index fund, for example, you are instantly buying a tiny slice of the 500 largest companies in the United States. With one click, for a very low fee, you are instantly diversified across the American economy. You own a piece of Apple, Microsoft, Amazon, Google, Berkshire Hathaway, and 495 of their friends. It is the single most effective tool. A beginner investor has to build wealth safely and systematically. But true diversification doesn't even stop there. It's not just about owning different stocks. It's about owning different types of assets. The two main players here are stocks and bonds. If stocks are the offense of your team, designed for high-scoring growth, bonds are your defense. Bonds are essentially loans you make to governments or corporations, and they pay you interest. They are generally much more stable and less volatile than stocks. Historically, when the stock market is crashing, investors flee to the safety of bonds, which often causes bond prices to go up. Having a mix of both stocks and bonds in your portfolio acts as a shock absorber. When your offense is getting hammered, your defense holds the line, protecting you from catastrophic losses and keeping you in the game. Now, I can already hear the objection. But if I diversify, I won't get those 10x returns. I'll never get rich off a boring index fund. And you know what? You're partially right. Diversification, by its very nature, means you will never capture the stratospheric highs of the single best-performing stock in any given year. But it also means you will never suffer the soul-crushing lows of the worst-performing stock. Protects you from ruin. Smooths out the ride. Investing isn't about hitting a home run on every swing. It's about consistently getting on base, year after year, letting the incredible power of compound interest do the heavy lifting for you. It's a strategy for winning the war, not just a single battle. Imagine another investor, Sarah. She starts with the same $30,000 as Kevin, but instead of going all in on Electron Motors, she puts 80% of her money into a low-cost total U.S. stock market index fund, and the other 20% into a total international stock market index fund. She is now the proud part owner of over 7,000 companies across the globe. When the short seller report hits Electron Motors, it barely registers as a blip in her portfolio. While the tech sector in her fund takes a hit, her healthcare, industrial, and financial holdings help to cushion the blow. Her portfolio might dip 5% or 10% during a market correction, but it doesn't get cut in half. She isn't panicking. She isn't losing sleep. She knows that while individual companies can, and do, go bankrupt, the entire global economy has never gone to zero. She sticks with her plan, keeps investing her money every month, and trusts the process. Sarah is building a skyscraper on a foundation of solid granite. Kevin built his on sand. Diversification is your seatbelt. It is your insurance policy against the unpredictable. It won't make you a millionaire overnight. What it will do is give you the highest probability of becoming a millionaire over time. By accepting the good but not spectacular returns of the entire market, you shield yourself from the individual disasters that can and will happen. But even with a perfectly diversified portfolio, a silent force is working against you. A hidden drain that can siphon off hundreds of thousands of dollars from your retirement account without you ever noticing. This brings us to the seventh mistake: paying high fees. It's the silent killer of wealth, a financial parasite that latches onto your portfolio and slowly, imperceptibly, bleeds it dry over decades. High fees are not just a minor annoyance. They are a mathematical guarantee of underperformance. Let me tell you a quick story about two friends, Alex and Ben. Both Alex and Ben are 25 years old. They both get a great start, each investing an initial $10,000. They're diligent savers, so they both contribute an additional $500 every single month to their retirement accounts. For the next 40 years, they both invest in funds that track the exact same index, let's say the S&P 500, and they both earn the same average annual return of 8% before fees. Their discipline is identical. Their starting point is identical. Their investment choices, for all intents and purposes, identical. There is only one tiny difference. Alex, who did a bit of research, chose a low-cost S&P 500 index fund with an expense ratio of 0.04%. That's 0.04%. Ben, on the other hand, went with an actively managed fund recommended by his friendly bank advisor. It also invests in S&P 500 companies, but it comes with a higher expense ratio of 1.04%. Just a 1% difference. It sounds like nothing, right? 1 penny on the dollar. What kind of impact could that possibly have? Most people would say, who cares? I'll barely notice it. And for the first year, they'd be right. But compound interest is a double-edged sword. It can compound your returns, but it can also compound your costs. Let's fast forward 40 years. Alex and Ben are now 65, ready to retire. They've both invested the exact same amount of money out of their paychecks. A total of $250,000 over 4 decades. Let's look at Alex's account first. His 8% annual return minus his tiny 0.04% fee gives him a net return of 7.96% per year. After 40 years of compounding, his retirement nest egg has grown to approximately $1.74 million. A fantastic result. He's a millionaire, ready for a comfortable retirement. Now let's turn to Ben. His 8% annual return, minus his 1.04% fee, gives him a net return of 6.96% per year. Remember, just 1% less than Alex. What does his account look like? After 40 years, Ben's nest egg has grown to $1.28 million. Let that sink in. Both started with the same money. Both invested the same amount every month. Both earned the same market return. But because of a seemingly insignificant 1% difference in fees, Ben has $460,000 less than Alex. $460,000. That's not a rounding error. That's a house. That's years of retirement income. That's the financial security for his family. Where did that money go? It didn't just vanish. It went directly from Ben's pocket into the pockets of the fund management company. He paid nearly $500,000 for the privilege of owning a fund that did the exact same thing as Alex's. This is the devastating power of fees. And the financial industry is built on making them as confusing and hidden as possible. So let's turn on the lights and expose them. The most common fee you'll encounter is the expense ratio. This is the yearly fee charged by a mutual fund or ETF to cover its operating costs, paying the managers, administrative costs, marketing, you name it. It's expressed as a percentage of your total investment. As we saw with Ben, even a 1% expense ratio can be catastrophic over the long term. For a simple index fund tracking the S&P 500 or the total stock market, you should be paying next to nothing. We're talking 0.1% or less. Many fantastic funds from Vanguard, Fidelity, and Schwab have expense ratios as low as 0.02% or 0.03%. If you look at your 401k statement and see funds with expense ratios of 0.8%, 1%, or even 1.5%, you need to understand that you are lighting a significant portion of your future wealth on fire every single year. Next up are advisor fees, often called assets under management, or AUM fees. If you hire a financial advisor, they will often charge you a percentage of the total money they manage for you. A common fee is 1% per year. Now here's the trap. This 1% AUM fee is on top of the expense ratios of the funds they put you in. So, if your advisor puts you in funds that have an average expense ratio of 0.8%,
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
and they charge you a 1% AUM fee, your total annual cost is 1.8%. You are now deep in Ben's territory, potentially losing hundreds of thousands, if not over $1 million, to fees over your lifetime compared to a low-cost DIY approach. A good advisor can be worth their weight in gold, but you must understand their fee structure. And you must ask them one critical question. Are you a fiduciary? A fiduciary has a legal obligation to act in your best financial interest. A non-fiduciary, like a typical broker, only has to recommend products that are suitable, which leaves a lot of room to sell you high-fee products that pay them a better commission. Then you have the really nasty stuff like sales loads. A front-end load is a commission you pay just to buy a fund. A 5% front-end load means if you invest $10,000, only $9,500 actually gets invested. The other $500 goes straight to the salesperson. A back-end load is a fee you pay when you sell. In today's world of low-cost brokerage firms, there is absolutely zero reason to ever pay a sales load. They are relics designed to enrich salespeople at your expense. So what's the solution? You need to conduct a fee audit on your own portfolio. Right now, log into your 401k, your IRA, your brokerage account. Make a list of every fund you own, identified by its ticker symbol. That's the 4 or 5-letter code. Then open a new tab and go to a financial website like Yahoo Finance or Morningstar. Type in the ticker symbol for your first fund. On the summary page, you will see, clear as day, a line item that says expense ratio. Write it down. Do this for every single fund you own. Are any of them over 0.5%? So ask yourself why. Is this a highly specialized, actively managed fund that has a brilliant manager consistently outperforming the market, even after accounting for the high fee? The data overwhelmingly shows that very few managers can do this over the long term. More likely, you're just in an expensive fund that is performing similarly to, or worse than, a much cheaper alternative. Compare its performance to a low-cost benchmark index fund like VOO, which tracks the S&P 500, or VTI, which tracks the entire US stock market. If your expensive fund isn't crushing these benchmarks, you are paying for nothing. You cannot control what the stock market will do tomorrow. You cannot control inflation or interest rates. But you can, with 100% certainty, control the fees you pay. Minimizing costs is the single most effective and reliable way to maximize your net returns over the long run. It's not about being cheap. It's about being smart. It's about ensuring that the money you work so hard to save is actually working for you, not for a fund manager on Wall Street. Once you've plugged this slow, silent leak of high fees, you've won a massive battle. But this victory can sometimes lead to overconfidence. You start to think, okay, I've optimized my costs. Now how can I supercharge my returns? I see the market going up and down. What if I could just sell right before it crashes and buy back in right at the bottom? I could make a fortune. This seductive idea, the siren song of every new investor, is perhaps the single most effective way to absolutely guarantee you underperform. It's a strategy that promises riches but almost always delivers ruin. This brings us to our 8th devastating mistake: trying to time the market. The allure is almost irresistible, isn't it? The idea that you, with your cleverness and intuition, can outsmart the entire world. That you can sell at the absolute peak, right before a crash, and then swoop back in at the very bottom to buy up stocks for pennies on the dollar. It's the plot of a Hollywood movie. It's a financial fantasy. And for 99.9% of people, that's all it will ever be, a fantasy. A very expensive fantasy. To time the market successfully, you have to be right not once but twice. You have to correctly predict the exact top to sell, and then you have to correctly predict the exact bottom to buy back in. Get either of these wrong and your entire strategy collapses. Think about the sheer arrogance required to believe you can do this. You're competing against millions of other investors, high-frequency trading algorithms that execute in microseconds, and entire floors of PhD mathematicians at Goldman Sachs. They have more data, more speed, and more capital than you could ever dream of, and even they can't consistently time the market. What makes you think you can? The truth is, this isn't about intelligence. It's about emotion. We try to time the market because of two of the most powerful forces in human nature: greed and fear. When the market is soaring, greed whispers in your ear, "It's a bubble. Sell now, lock in your profits, and buy back when it crashes." Then when the market does crash, fear screams, "Get out. Sell everything before it goes to zero." You end up selling low out of panic and buying high out of FOMO, the exact opposite of the buy low, sell high mantra. Let me give you a statistic that should stop you dead in your tracks. A landmark study by Fidelity looked at the S&P 500 over a 40-year period. They found that if you had stayed fully invested the entire time, you would have earned a handsome return. But if you tried to time the market and missed just the 10 best trading days in those 4 decades, just 10 days out of more than 10,000, your total return was cut in half. Slashed by 50%. Missed the 30 best days? Your return was almost completely wiped out. Gone. And here's the kicker, the part that makes market timing virtually impossible. The market's best days often happen right next to its worst days. They cluster together during periods of extreme volatility. Think about March 2020. The market was in a free fall. Panic was everywhere. Many people sold, thinking they were being smart, protecting their capital. But some of the biggest single-day gains in stock market history happened in the days and weeks that followed, while those smart people were sitting on the sidelines in cash, waiting for a safer time to get back in. By the time they felt safe, the market had already rocketed back up, and they had locked in their losses permanently. Let's make this real. Imagine two friends, Tim and Sarah. They both start investing in January 2020 with $10,000 each in a simple S&P 500 index fund. By late February, the pandemic fears hit, and the market starts to plummet. Tim, our market timer, watches the news every night. He sees his $10,000 turn into $9,000, then $8,000. He panics. In mid-March, he sells everything thinking, "Phew, I saved myself from further losses. I'll get back in when things calm down." He feels like a genius. Sarah, on the other hand, does nothing. She feels the fear too. It's painful to watch her account balance drop. But she remembers her plan: invest for the long term. She closes her laptop and goes for a walk. She trusts the process. What happens next? The market bottoms out just a few days after Tim sold. Then it begins one of the fastest, most ferocious recoveries in history. Tim is paralyzed. He watches from the sidelines. "It's a dead cat bounce," he tells himself. "It's going to crash again." But it doesn't. Keeps going up. Now he's in a mental trap. He sold at $8,000. The market recovers to his original $10,000 level. He can't buy back in now. That would mean he went through all that stress for nothing. He decides to wait for a dip. The market climbs to a value that would have made his portfolio worth $11,000, then $12,000. Tim is still waiting, paralyzed by his own clever decision, while Sarah's portfolio is now hitting all-time highs. By the end of the year, Sarah's $10,000 is worth well over $11,500, while Tim is still sitting in cash, having locked in a 20% loss and missed out on a 40% gain. Over decades, this single mistake could cost Tim hundreds of thousands of dollars in lost compounding. So what's the antidote to this self-destructive behavior? It's a simple, powerful, and almost boringly effective strategy. It's summed up in one of the most famous sayings on Wall Street: "It's not about timing the market, it's about time in the market." The solution is to let time do the heavy lifting for you, and the best way to do that is through a technique called dollar cost averaging. Dollar cost averaging, or DCA, sounds complicated, but it's incredibly simple. It just means you invest a fixed amount of money on a regular schedule, no matter what the stock market is doing. For most people, this is how their 401k works. A set amount of money comes out of every paycheck and gets invested, whether the market is up, down, or sideways. You can set this up for any investment account. $100 every month. $50 every Friday. The amount and schedule don't matter as much as the consistency. Here's why it's so brilliant. First, it completely removes emotion from the equation. You don't have to guess if it's a good or bad time to invest. The decision is already made. It's automated. Your investing runs on autopilot, immune to fear and greed. Second, it has a hidden mathematical advantage. When you invest the same dollar amount each time, you automatically buy more shares when the price is low and fewer shares when the price is high. Let's say you invest $100 a month. In month 1, the share price is $10, so you buy 10 shares. In month 2, the market dips and the price is $5. Your $100 now buys you 20 shares. In month 3, the market recovers and the price is back to $10. You buy another 10 shares. After 3 months, you've invested $300 and you own 40 shares. The average price you paid per share wasn't $10, or even the simple average of $10 plus $5 plus $10/3, which is $8.33. The actual average cost of your shares is your total investment, $300, divided by your total shares, 40, which is just $7.50 per share. By investing consistently, you lowered your average cost and positioned yourself for greater profits when the market recovers. You turn market volatility, the very thing that terrifies market timers, into your friend. This is the secret. This is how you build real lasting wealth. Not by making brilliant once-in-a-lifetime calls, but by making disciplined, consistent, and frankly boring contributions over a long period of time. You let the power of compounding and the long-term growth of the economy work for you. You accept that you cannot predict the future, and you build a system that doesn't require you to. But even if you master your emotions, avoid timing the market, and consistently invest through dollar-cost averaging, there's a silent killer that can eat away at your returns without you even noticing. It's a tiny percentage point that, over decades, can cost you hundreds of thousands of dollars. This leads us to our 9th mistake, one that is deceptively simple yet profoundly destructive: letting fees destroy your wealth. Think of it like this. You have 2 buckets, and your goal is to fill them with water from a rainstorm. The rain is your investment returns. Both buckets are catching the same amount of rain, but one bucket has a tiny, almost invisible hole in the bottom. At first, you don't even notice the drip. But after hours in the storm, you come back to find one bucket is nearly full, and the other is half empty. That tiny hole, that drip, that's your fees. In the world of investing, these fees have fancy names: expense ratios, management fees, trading costs, 12b-1 fees. It's a confusing alphabet soup designed to make your eyes glaze over. But all you need to know is this: they are a direct parasitic drain on your money. The most common culprit is the expense ratio on mutual funds and ETFs. It's the yearly percentage the fund company takes out of your investment to cover their costs and their profits. You might see a fund with a 1% expense ratio and think, 1%? What's the big deal? That is the most expensive thought you will ever have. Because that 1% isn't just 1% of your initial investment. It's 1% of your total assets every single year, for the rest of your life. And it compounds against you. Let's run the numbers, and I want you to really absorb this. Imagine 2 investors, Sarah and Tom. They both start with $10,000 and invest $500 a month for 30 years. Both of their chosen funds earn an average of 8% per year before fees. The only difference? Sarah invests in a low-cost S&P 500 index fund with a tiny 0.04% expense ratio. Tom, on the other hand, was sold a popular, actively managed mutual fund by a friendly guy at his bank. It has a 1.2% expense ratio, which sounds reasonable to him. After 30 years, Sarah, the low-cost investor, has approximately $935,000. A fantastic result. She's on track for a comfortable retirement. Tom, who earned the exact same 8% return before fees, looks at his statement. His balance? Around $740,000. Let that sink in. Tom paid nearly $200,000 for the privilege of investing in a high-fee fund. That's a house. That's a college education for multiple kids. That's years of his life he has to keep working. It's a silent theft that happens in decimal points, day after day, year after year. He did everything else right. He saved, he invested consistently, but this one simple mistake cost him a fortune. The solution is brutally simple. Before you invest a single dollar into any fund, find its expense ratio. It's legally required to be in the fund's summary or prospectus. Your new religion is low-cost investing. You should almost never be paying more than 0.2% for a core fund, and for broad market index funds, you can easily find options below 0.05%. Companies like Vanguard, Fidelity, and Schwab built their empires on this principle. Reject the idea that higher fees mean better performance. Over 90% of actively managed funds, the ones with the high fees, fail to beat their low-cost index fund counterparts over the long run. You are paying more for less. Don't do it. Now, we've covered 9 massive mistakes. From trying to time the market to letting fear and greed be your guide. From putting all your eggs in one basket to being destroyed by fees. If you avoid just these 9 pitfalls, You are already ahead of the vast majority of investors. But there is one final mistake. A mistake so fundamental that it acts as the foundation for all the others. It's the master mistake that, if you make it, guarantees you'll fall victim to the others again and again. The 10th and final mistake is investing without a plan. It's going on a cross-country road trip with no map, no GPS, and no destination. You just start driving. You'll take a turn because it looks interesting. You'll follow a fancy car hoping it leads somewhere cool. You'll slam on the brakes and turn around every time you see a scary-looking cloud on the horizon. You'll burn a ton of gas, experience a lot of stress, and end up lost in the middle of nowhere. This is what most people do with their life savings. They hear about a hot tech stock on the news, so they buy it. That's an interesting-looking turn. Their crypto-obsessed cousin tells them about the next big coin, so they pile in. They're following a fancy car. Then the market drops 10%. News channels flash red with headlines of crash. And they panic sell everything, locking in their losses. That's the scary-looking cloud. Investing without a plan is not investing. It's gambling with worse odds. Because your opponent isn't the house. It's your own emotional, irrational, panic-prone human brain. Plan is your defense. It is your logic in the face of chaos. It's the pre-written script you follow when the world is screaming at you to do the exact wrong thing. So what does this plan look like? It doesn't need to be a 100-page document. It can be written on a single index card. It's what's known as an investment policy statement, or an IPS. Think of it as your personal investing constitution. It's a set of rules you write for yourself before you start, when you are calm and rational. Your plan needs to answer 3 simple questions. 1. What is this money for? Be specific. Is it for retirement in 30 years? A down payment on a house in 5 years? Your child's college in 15? The purpose dictates everything. You wouldn't invest money you need in 2 years the same way you invest money you won't touch for 4 decades. 2. What is my strategy? Based on your goal and your time horizon, what are you going to invest in? A simple, effective strategy for a long-term goal could be, my portfolio will be 80% in a total U.S. stock market index fund and 20% in a total bond market index fund. That's it. You've just defined your asset allocation. 3. What are my rules of engagement? This is the most important part. You need to write down your own rules. For example, I will add a set amount of money every single month, no matter what the market is doing. I will rebalance my portfolio once a year on my birthday to get back to my 80-20th split. I will not sell anything ever, unless I am pulling money out for my stated goal of retirement. That's it. That's your plan. You write it down, you put it somewhere safe, and you treat it as law. And when the market inevitably plunges 20% and your gut is screaming sell, get out now. You don't listen to your gut. You don't listen to the talking heads on TV. You pull out your plan. You read the words you wrote when you were rational. I will add a set amount of money every single month, no matter what the market is doing. And you do exactly that. You buy more just like you promised yourself you would. This plan transforms you from a panicked passenger into a calm and confident pilot. You are no longer reacting, you are executing. You have a system. And that is the ultimate secret to successful investing. It's not about finding the next Amazon. It's not about being a genius who can predict the future. It is about creating a simple, sound plan and then having the discipline and the courage to stick with it for a very, very long time. It's about automating your decisions, paying yourself first, keeping your costs microscopic, and letting the magnificent power of compounding do the heavy lifting for you. You've made it to the end of this journey. You now know the 10 biggest landmines waiting for every new investor, and more importantly, you have the exact map to navigate around them. You have the knowledge to build a powerful engine for wealth that can change the entire trajectory of your life and your family's future. But knowledge is only potential power. The real power comes from action. The journey from where you are now to financial independence isn't about one giant leap. It's about one small step taken today. Open that retirement account. Write down your one-page plan. Make that first small investment into a low-cost index fund. The best time to plant a tree was 20 years ago. The second best time is right now. Your future is not a matter of chance. It's a matter of choice. Go build it.
Disclaimer. The information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, You agree not to hold the creator liable for any loss or damage arising from your use of the information provided.